Hi, my name is John Stevens, and welcome to the Guaranteed Retirement Guy Show. Today, let's talk about CDs, bonds, and are people putting money into those? Or are they putting them into annuities instead? Where is the smart money going right now? And this is for people that are super wealthy down to people that are just starting their retirement journey. There's a lot of things happening right now that you need to know. So I sell annuities, disclaimer, that's how I make my money, right? It's nothing wrong nothing wrong with CDs or bonds or stocks. I love those as well. But I want you to at least know what people are doing and why they're doing it for their portfolios, because it absolutely will I think perk your interest, especially when you see where rates are right now. And if you're already looking for annuities, then you already know what they're paying, and there can be some very, very high contractual guarantees. You've got high contractual guarantees for lifetime income. You can buy a pension that's relatively very large compared to what you put in, and you can also put money into annuities that are paying like 5 or 6%, beating your bond portfolio and your CDs, and allowing you to do that 60-40 split. Maybe you want to do that 60% into bonds, or maybe it's 60% into stocks. And you want to put 40% into bonds, but they're just not giving you what you're hoping for, and you're worried about interest rate risk on those, especially if you buy it and the price of bonds decide to skyrocket. Then obviously, or interest rates skyrocket, then obviously the value of that underlying bond goes down, and that can cause some problems. So especially with an inflationary environment that we're in, that is a real concern for a lot of people that are trying to balance their portfolios. So I'm going to share my screen. I'm going to show you some things that people are doing with me right now, and what they're just doing with their portfolio. And I'm not here to sell you something. Obviously, if you want to purchase an annuity, I can help. There's a link below this video. If you go there, you can go directly to my calendar, and it'll be a Zoom meeting. Okay. If you go to my website, johnstevenson.com, you can book a meeting with me there. There's also annuity calculators that you can do your own research on. So I like to show what's available. I like to educate, and then if people feel comfortable, they can reach out to me. So that's just a soft sales pitch. So all right, so let's look at this together. So I've got a client in Texas that got $500,000, and they're 62 years old. Okay. Well, they're 60, excuse me. They're 60, they're married, they're both 60, they're going to take income, let's say at 62. And I'm going to do this real quick on the income, because this is not where I want to focus my time on this video. So 62, they're going to take out $39,000. Guaranteed income is joint for life. You can see all the rest of the carriers. There's a lot of options. This top one happens to be F&G. So it may be different for you depending on your state, your age, and whether or not you're taking a single or a joint payout. Okay, this is a joint payout. So we look at that and say, okay, well, yeah, but I might wait till I am 67. Okay, I've got money right now. I'm going to keep working till 67. I'm going to take my Social Security at that age, and I'd like to take income at that age from an annuity. Well, $500,000 is going to give you $60,000 a year for the rest of your life. And if you chose ClearSpring, let's say you chose that one. Good company. They used to be Guggenheim, and they are paying, let's see here, $60,618 for the rest of your life. And if you live to 95, you're going to take out $1.7 million. Okay. And it does not matter how long you live or your spouse lives. And if you guys die early, then whatever is in this account will go to your beneficiaries. And you can see right here, there's a death benefit. Okay. That lasts for as long as your account does. So that's important for you to know. If you're looking to lock in rates and you want part of your portfolio to be income, maybe you do want to do a 60-40 split, but you want 60% to be in stocks and 40% to be income. Maybe it's not bonds. You just want to have income from something that'll pay you a lot more than a bond will or a CD. Then that is what a lot of people are doing. They'll take 40%, they'll put it into their annuities or whatever they need. I mean, it might be, maybe you need 50%. Everyone's different, but they'll put it in, they'll buy their pension, and they'll have Social Security or their pension, maybe from their past employer paying them as well. And they use these contracts to provide lots and lots of lifetime income that they cannot outlive. Because that is, in my opinion, the number one fear that retirees have is, do I have enough money? And I want to have as much income as possible, but I don't want to run out. How do I do it? Well, in my opinion, the best way to do it is through contracts. Okay. Contractual guarantees. Okay. All right. So let's go back here, and I'm going to get off the lifetime income. And I'm going to go talk about just replacing that. Let's say you want to do 40% into something that's similar to your bond portfolio, but you don't want to have the interest rate risk. Okay. If your interest rates go sky high, you don't want that to cause the value of your bond portfolio to go down. Right. So what are you going to do? You're going to look at maybe a MYGA. Okay. A MYGA is a multi-year guaranteed annuity. So Let's take a look at those. MYGAs are like CDs, okay? And what I like about them is with a CD, you can buy it with non-qualified money, just cash, and you'll be taxed every year on the earnings. With a MYGA, you're not. It's a tax-deferred vehicle, even if it's non-qualified money. So that's really, really nice. So what you could do is you say, well, I want a 7-year term. What are the best options? Okay, and again, this is for 40% of your portfolio. You just want the highest growth. So you look at these and say, okay, well, it's 5.25. That's not bad, but this is A+ or higher. I'm okay with an A-. Okay, look at A-, 5.5. Not bad. But you're thinking, well, what's a B++? I like a B++. They're good companies. They still got a lot of money. Okay, well, look at this. American Gulf, 6.3 if I don't want any withdrawals. But let's say I want to have access to some of that money. I want to strip off the interest. Okay, well, 6.15, and they allow up to 10% right after the first year. Now, if I wanted interest only right from the beginning, like the next month, then I got to be happy with a 5.95 from Heartland National. See, that's how that works. It's very, very simple, but it works very, very well. And you might be looking at this thinking, wow, this is a lot more than my bond portfolio is paying me, or or maybe my CD, right? Then it can be a great option. You might leave, if you got $1 million, you might leave 600,000 in stocks. You might take 400,000 and put it into something like this, knowing you got a guaranteed 6% paying you for that portion of your portfolio. But at the same time, you might think, well, that's not enough. I'd like to get a little bit more. Can I get some index growth? Yes, you can. Let's look at those. So if we go over to my performance analyzer, and of course, that's all I do is annuities. And so because of that, I have access to thousands and thousands of variations. In fact, this page just has 3,500. Okay, and we're not even talking about MYGAs. Okay, we're talking about just index options. Then we got the income ones, which I talked about in the beginning. So it really depends on where you want. Like if you're looking at that 40% of your portfolio and you want like, all right, where do I want this? In bonds or CDs? Or do I want MYGAs? Or do I want an index annuity? Or do I just want income? I just want lifetime income and I want the rest of my money to grow and I want to retire. I want to enjoy my income, which most people will pick that. They'll pick the income product. Okay, so for this, we'll say we are looking for something. I'm looking for something, though, that has a high renewal rate. What I mean by that is if they give you half of the index, like you want them to keep giving you half of it instead of lowering it to 20% of the index, which a lot of times happens. So I'm going to go to a company that I know very well, and they have a good history of keeping their renewal rates constant every year. Doesn't mean they don't lower them or raise them, but they do try to keep them pretty constant from where you got in. So that's important. Because a lot of times you'll buy an index and it looks great and they'll give you a 200% participation and it's nothing. It doesn't earn anything. It's just a back-tested index that means nothing. Or you'll get an S&P index cap of 15% and they'll lower it to 6. That's the problem. I don't want you to have that kind of problem when you're allocating a portion of your money into these type of contracts. So if we're looking at this and we'll say, let's go up here, see here. I want the 55%. I want to get as much as I can. So, and there are other ones that give you a little bit higher, but they measure a longer period, like 5 years, which you can have good 3 years and bad 2 years and then earn nothing. I like to have it put money into your account and compound every single year. So based off of this, 500,000, if it makes nothing, obviously nothing happens. They do have a guaranteed minimum value, which is kind of nice. So if it has no earnings whatsoever, they do give you something for having your money there. But I've never seen this happen unless, of course, you have like a 10-year recession where the stock market never goes up once. But if you look at actual growth, here's what it looks like: getting 55% of the S&P 500. Okay, that little portion of your portfolio grows pretty nicely, and you can see, like the good years, you're making way more than a MYGA pays you. Okay, so you're getting a little bit more than a MYGA. There are some years where you don't make anything though, so because it is tied to an index. They're buying call options, and if they can exercise those call options, then you'll make money. But if they can't, the market's down, then they won't exercise them, and you won't make any money, but you won't lose any money either. But if you look over the long term, okay, go down here, we'll look at the average effective rate of return is 9%. Well, that's a lot better than 6%. Okay, so but if you're thinking like a short period of time, or like I really just need this to be allocated for 5 years, then just choose a 5-year MYGA. Okay, that would be better than maybe this, because this is more of a long-term approach. Okay, 7 to 10 years or longer. Then an index approach, like something like this, can work very, very well and net you a lot more, maybe $200,000 or $300,000 more for the same time period versus a MYGA. So just have to think about what you need, what you want for your portfolio. So, all right, the video's over. I just wanted to just kind of wrap up and just show you really what you can do. If you are looking to purchase an annuity for yourself, you need some help, and you want someone who's transparent, who's willing to show you everything, then I'd love to help. There is a link below this video. You can go directly to my calendar, or you can go on my website, johnstevenson.com, and there's a link right there to book a call. It's a Zoom meeting, but we'll get on that Zoom meeting and I'll show you my screen. I'll show you everything that's available. We can kind of go through the numbers. I'll download some PDFs. I'll send them over to you. And of course, if you're looking to purchase, I'd love to help you. So anyways, I hope this has been helpful. Hopefully you've been able to get some of your questions answered, maybe help you think a little bit different about your portfolio and how you want to allocate it. There are good options out there. You just have to know where to look. So hopefully this video has helped you learn to look in maybe the annuity space, because the annuity space can be good. There's a lot of guys that preach against it. A lot of big advisors that say, oh, annuities are terrible. Well, they're all about growth and stock, and I get it. And if you're looking for highest growth, then yeah, annuities are terrible. You just need to do stock, right? But if you're looking for some market protection, and which often many of us want that, then you'll use an annuity contract for its contractual guarantees for either income or just for some guaranteed growth, market protection. It's nice to be able to have it. So that is a tool that you can use to be able to benefit your retirement portfolio. So if you want help with that, I'd love to help you. Anyways, if you like the video, make sure you like, subscribe, share, comment below. And I do appreciate you for watching, and we'll see you next time.